Right, today I would like to discuss a bit about the jobs market. Right, jobs, as you know, stumbled, and it's the Fed coming to the rescue. Okay, so we're going to analyze the October's weakest employment report in 4 years. So the latest U.S. jobs report released by the Bureau of Labor Statistics, the BLS, presented concerning data about the economy's employment trends. Now, in October, only 12,000 jobs were added, and this is the weakest monthly gain in 4 years. Now, it's speculated that several factors, including recent hurricanes, but the Boeing strike contributed to lower than expected jobs growth. Now, in contrast, September's report showed a robust gain of 254,000 jobs, underscoring the steep decline this month. Now, despite this, right, the unemployment rate stayed unchanged at 4.1%, a historical low level. And this has been touted by Biden, saying that he has done a good job. So far, employment remained low under his tenure. And but if you look, there are indications that it has been gradually rising. You just can't deny that. Okay. So first of all, let's move and look into the sectors impacted and the employment trends. I think that is pretty crucial. Now, the jobs growth was concentrated in healthcare and government sectors, while the jobs losses were notable in manufacturing, leisure and hospitality, retail, and transportation and warehousing. Okay. Now, this sector-specific distributions reflects a shift in jobs demand, suggesting that the economic slowdown is affecting industries differently. The BLS also revised its job creation estimates for August and September downwards by 112,000 jobs. Now, this is not a small number. This is a huge number, and this is not the first time they've done that. Now, remember, we had really huge numbers, and there's no point getting huge numbers later to revise them equally with 6 digits as well. So this highlights the potential inaccuracies in previous reports and casting further doubts on the overall jobs growth trajectory. Okay. Now, these adjustments reflect a more subdued labor market than initially reported. Not only that, let's move on to the JOLTS to get some insight right there. Now, additional data from the JOLTS, right, shows a steady rise in layoffs, indicating a cautious hiring approach among employers. Although hiring figures appeared to increase slightly over the past 3 months, a closer look reveals an overall downwards trend in hiring, adding to concerns that labor market is cooling. Now, this labor market shift to an employer's market means fewer employees are quitting their jobs, likely due to difficulty of finding new well-paying positions. So how's the Fed going to deal with the interest rate? Probably. Okay. Now, given the week's job report, the week one, right? Market and participants now anticipate further actions by the Fed. Before the report, there was already a 98.4% likelihood of a 25 basis point rate cut at the upcoming November 7 meeting. This expectation barely shifted now after the report, where the probability is now 98.9%. So not an issue. However, looking further ahead, the probability of an additional 0.25% cut in December rose from 74.6% to 82.7%. This actually strengthens. They're still looking at another 25 basis points. So this reflects increased expectations for continued monetary easing to support the labor market. So even with the weak numbers, we are not looking at a 50 basis point cut. Okay, and this 25 basis point cut that you can say has been already reflected in already. So it's not really an issue right now. Okay. So Now, if you look at the stock market, how it responded, interestingly, the stock market opened higher despite the disappointing jobs report. This seemingly counterintuitive response is driven by expectations that the Fed will lower rates in response to the weak job data. Now, lower interest rates make borrowing cheaper, which can stimulate investments and consumer spending, factors that typically boost stock prices. Now, the market's positive response underscores its reliance on the monetary policy as a buffer against economic downturns. So this thing, the Fed, FOMC meeting will come out roughly or 2 days on the third day after the presidential elections. That will be on Friday. So that actually could change, but whatever it is, what you see, I would treat it as based on the presidential results, it would be temporary. And we need to see it in the longer term, how it is being planned out. And then from there, we will have a better idea. Nevertheless, from these data right here, you can already more or less understand, right now, November is a done deal, 25 basis points. We'll probably have another 25 basis points coming in December. And that actually coincides with the Fed's projection. So with that, that's the report for today.